Ladies and gentlemen of the crypto space, we're live on a Monday, April 28th at 11:31 a.m. and I'm opening with a boomer meme coin chart. So this is the Nasdaq and I'm flipping through my data and I see the most insane candle ever. That's a dragonfly doji. It is basically where the opening price is right on the closing price. That is the slimmest doji. I mean, we're talking about August of 24. Fine, fine. Maybe there is some history. And this is just a crazy doji. That's a shooting star if I've ever seen one. And that just blew right past it with invalidation. All right, fine. I take it back. I was going to start this stream saying this is an absolutely insane candle. And then in 5 seconds, I see a whole bunch of candles that are equally just as insane. I mean, look at that back in February of 23, followed up by March. And then obviously in August of 24 is probably just as insane as what we're looking at right about now. Let's flip back. Maybe there's something interesting. 2020 was boring in comparison. And in fact, 2020, there's nothing really interesting to talk about at all from a NASDAQ perspective. Um, it is much more volatile and much more interesting what's going on now. I mean, at least in 22, there was a 50 SMA mean regression. You didn't even get a 50 mean regression back in 2020. You literally didn't even get it. You punched obviously the 10, which is the darker green moving average, but you didn't even get to the 50, at least in 22. So that was your big mean regression. And this is just I don't know. The world's trying to decide what the hell's going on with India and Pakistan right now, yet alone everything else. But that's the headline for today, obviously. Just an insane candle to say the least. Gold continues its march, 3,325. So obviously I'm looking at what catches my eye, part of the watch list. And gold is what stands out today. Your signal through the noise that everything is continuing this current directionality. Madness will persist, volatility will persist. Therefore, the same bet remains. Nothing changes. The story hasn't changed. And it's irrelevant even if the story changes because there's only one side to the bet, which is what I try and explain to everyone. Listen, this if there's a deflationary cascade, it doesn't matter. It's all over. It's chaos. So you can't bet on that. There's no point of betting on that. And frankly, financial instruments are not how you bet on that. Are you really betting that NASDAQ is going to get cut in half 50%? You think it stops after 50%? You think they have a capacity to control it collapsing 50%? People talk about, oh, where's going to be the bottom of a crash? No, that's such a silly statement. There is no bottom. The whole carry trade gets unwound. And the biggest carry trade on the planet is literally the dollar itself. And if the dollar starts to unwind, and there's no stopping that, there's no control over that leverage invalidation or that leverage unwind. There's no control over that because it just begets more leverage unwind. And then as the dollar carry trade unwinds, the dollar goes straight up in value, straight up and to the right. Isn't that the greatest irony of it all? Absolutely. So until then, until that day where the world ends and Immortan Joe becomes our next president, we have our financial instruments and continued financialization. So that is what the system is still waiting on. Where is I don't have any real indicators, do I? I mean, this is just straight horizontal compression for the Fed balance sheet. The reverse repo is kind of really what I want to look at. Overnight reverse purchase agreement. There you go. It's down at 94. That's crazy. So when folks see this on like social media, they're like, "Oh, the reverse repo's down at 94," and then they hear other people talking, and they're like, "Oh, if it goes to zero, the market's gonna pump." It's like when it goes to zero, it's instantaneously a bull market. That's not the way markets work. Oh, it doesn't. There's no flipping of switches. There's no instantaneous expectation and response. Things don't work instantly. Things have endless buffer on each side of what's potentially going to play out. So the point is, this will go down lower. At some point, the Fed will probably have to respond with some balance sheet management, which they don't want to do at all. Too much poor optics surrounding it. There's a lot of curious possibilities how things play out. It's really this year because it's a very different personality, Besant versus Yellen. To say the least, is that I think? Can I say a more short-sighted statement? They're antithetical personalities. One thought, "Oh, the greatest system. Oh, praise Yellen. It's the greatest system. Everything was working." And then Besant comes in and coordinates with the administration to basically turn the system on its head because it was such a great system as anti-Yellen uh, states. And I don't think anyone in their right mind agrees with that. The system is a managed system. Here, for instance, here's an interesting one: financial systems. The system is good or the system is bad. How people interpret whether it's good or bad is such a shallow inspection in so many regards. For instance, markets start falling apart and everyone gets airdropped 500, $1,000, which is literally what happened in 2020. And they feel like they're getting something from the system, and they did get something from the system, but the stock market was falling apart. Oh my goodness, the shallowness or the ease of influence over the general public with regard to sentiment of economics. Everyone was out of work and they received some sort of benefit. In the end, social civility is financed, or at least it will be, even if it's the end. Do you understand what I'm saying with that? So, no matter what, whether it's game over or they're able to continue managing the status quo and allowing it to persist for another cycle, we're going to see the attempt at financing of social civility. None of it means the system is good. Anyone that has exercised even a bit of due diligence knows the system is a catastrophe. But that's irrelevant. That's a first order takeaway. The first order takeaway is, oh, the system's a catastrophe. I need to short the NASDAQ. I need to short the corn. Second order inspection would be the system is a catastrophe. None of it matters anyway because if everything unwinds and the dollar carry trade unwinds, we have Morton Joe as our next president, so who gives a fuck? And then the third order takeaway is the system is a catastrophe. It's inevitable that social civility is financed anyway. So buy the corn, buy the NASDAQ. So your choice, ladies and gentlemen, with regard to are you the type of personality that responds to first order, second order, or third order? So obviously it gets simpler as you get up to the third order, and you're like, all right, they're going to finance this shit. So nothing has changed. Okay, so we have the right assets, we own the right businesses, and the only other component of the equation is time. And time for what? time for the optics of financing of social civility to be favorable from a political perspective. Once that's the case, then they execute. Until then, nothing matters. They're going to finance it when they do. All right, great. Everything else makes things too complicated. Um, Look at all your cross currency pairs as much as you want. You'll drive yourself nuts. DXY down at 99,259. 2 days, 8 hours left for a monthly close above the monthly 100. Let's see where we are in the weekly. Firmly below the weekly 200. Wick through the monthly 100. Now, obviously, the lower the DXY goes, the more favorable the economic conditions are, in my opinion, from an emerging market standpoint. But we don't have an optimal backdrop with regard to money. That's currency. DXY is relative currency valuations, or a snapshot of relative currency valuations from an index perspective, which has proportionality, so on and so forth. But move and 10-year tell us the story we really need to understand from a money perspective. So right now, money is still a little cheap. Um, as money appreciates and yields fall, money will be in a better position to print currency. And as the world is in a better position to print currency, they're gonna need to print it anyway because they have to refinance at least nominally service 2025's debt requirements, the interest expenses. So they're gonna have to deal with these interest rates as best as they can. But maybe that's what it is. Maybe they're waiting to see if U.S. administration can finagle interest rates a little bit lower, so people and countries and corporations can get a little bit more bang for the buck with regard to their conversion of money to currency, so they could finance or just service their outstanding debt, yet alone refinance whatever needs to be refinanced this year. Maybe they're waiting for the U.S. to make a move first because what was there 7.5 trillion, and then another was 7 trillion, I think it was, another 2.5 in deficit spending. So what comes out of Treasury this year is about 9.5, $10 trillion, give or take, depending on how bad they fuck up the budget. So I think that makes sense. The rest of the world is probably waiting to see what the U.S. plan of attack is for debt refinancing. And you know why they're waiting? Because if the U.S. has to issue and refinance that amount of debt, um, the rest of the world expects interest rates to come down, which gives them a better opportunity to get a better conversion of money into currency, which gives them more bang for the buck. So basically, the rest of the world right now is arbitraging or waiting to see what kind of arbitrage the U.S. offers for the global refinancing obligations. They're letting the U.S. move first, and then because they have to engage. It's not like that's not the way it works. They have all the stuff they have to do this year. It's not an option. These are financial obligations that are between every country on the planet. So that's kind of why the title of the stream was Ouroboros and inevitability, because it's as inevitable in the Ouroboros is that the system causes itself. That Ouroboros is like inflation is deflationary, or deflation is inflationary. Where the system is heading is caused by where the system has been, and where the system has been is caused by where it's heading. You understand? Or you could just think about Ouroboros from Marvel's Loki and his relationship with Victor Timely. That was a fun story to say the least. One of my favorites, actually. Well, that's really a paradox because they both created each other anyway. But that's the point. That's what kind of the Eurodollar is. It created itself. The vast majority of dollars in existence are dependent on continuing to pay the interest rate associated with the dollars coming into existence. Because if the interest rate isn't paid, the dollars come out of existence and destroy currency, which drives up the price of the dollar. Oh, dear Lord, that will drive many folks insane, wouldn't it? Either you're defaulting on US debt, which makes US dollars more scarce, which drives up the value of the dollar, which makes it that much harder to pay interest rates, dollar denominated, which drives up the value of the dollar, which begs the question, how the hell does the dollar go down in value? Well, this is where cyclicality comes in. Dollar comes down in value when you need US interest rates to come down. And that's what the US administration needs. They need a weaker dollar in order to execute their policy objectives. So that statement right there implies the only reason the dollar comes down is because the powers that be actually want it to. DXY at 99, there's still a shortage of dollars. Now, we're not talking about, inflation, shortage of dollars, stuff like that, because currency is relative. The supply of currency is relative. The supply of currency doesn't give a shit about the supply of currency relative to goods and services. The price of currency gives a shit about the relative supply of currency to other currencies, which goods and services are not. So the dollar is still relatively scarce. It has, I mean, look at this damn chart. It's remarkable what it went through over the last couple of years. In so many regards, we just experienced 15 to 17, a prolonged 15 to 17. It's just on the verge of, it's really what Julian Biddle and Raoul talk about, like how damn close we are to cycles will cycle type phenomena. Folks have inspected global M2 going up, or they're inspecting the reverse repo basically being drained, or they're inspecting interest rates, 10-year yields going up, even though the dollar's coming down, and they're like, okay, someone's gonna have to come in and normalize the relationship because yields can't go up with the dollar coming down. That's a systemic contradiction. So we're right on that threshold of either the system failing or the system kicking on the expansion phase. From a cyclical perspective, the cycles will cycle. Currency supply needs to expand in order to service outstanding debt obligations as well as to refinance anything that needs to be refinanced, like a Mike Howell type of conversation with regard to balance sheet capacity and how he defines liquidity. Because otherwise, if he can't refinance, it's a refinancing crisis. Again, as Mike Howell talks about. So that everyone tells the same story, just with slightly different language. It's like watching a version of a Disney movie from 5 different countries. It's all basically telling you the same story, just slightly differently. So either you bet that the system is going to be able to refinance everything, or you get a giant refinancing crisis and it's all over anyway. Gold at 33.27. This has been just a remarkable run. Look at that, 667% between bottom and 2001. and top in 2011. 10-year period, 667%. And we're in 16, damn, 9-year period, only 227, diminishing returns. Looks like the system needs a significant expansion of capital for gold to catch up. At least that's what that relative percentage indicates. All right. Anything else interesting? Curves cash flows at about 18%. Nothing to sneeze at. That's a tremendous number, given that U.S. government debt is hovering at 4.23%. So we're talking about almost almost 500% premium. So when you talk about interest rates, you want to get paid for the risk you're taking or the duration. So obviously with government debt, it's more so duration. It'll always be nominally serviced no matter the relative currency valuation. But it's either duration, which is just risk. So ultimately it all reduces to risk. So you're getting paid almost a 500% premium on top of risk-free um, for the exposure to this kind of volatility. And no, that's not the volatility that matters because there's an entire story to be told. And it's really like the last year, well, more, 2022. So this period right here is really the period to inspect. Everything that occurred before was too much of an inception phase to be significant from really understanding where things have gotten to the current state and form. Current state and form has all the Federation's components, obviously convex finance, but not only the Federation's components, but they are all established at this point. Convex is robust, Frax is robust, resupply is online, F of X. I mean, Cleaver's doing what it's doing, it's just accumulating. Where is, nope, nope, yep, right here. We'll go here, we could go to convex, and Cleaver is the top owner of convex. I mean, it's pretty wild when you think about it. And it's the second being Pyrac, but it's twice as much. Cleaver is just far in the lead, so it's just quite outside of the general public's understanding the significance of this. Now, whether this becomes extraordinarily significant in the future or not is another story, but it is currently significant. What does that mean? That's more so like price. Does the general public respect and appreciate the governance capacity of Cleaver? I don't know. That's not up to me. That's up to the general public. But you realize what Cleaver controls from a voting perspective. I mean, there's just 67% discount to intrinsic values. The amount of governance power that Convex controls, and then to top it all off, how much how much how much Convex Cleaver controls. It's just a remarkably strong position. Like buying one Cleaver is like buying 40, what was it? 40 to 1 Convex, and then Convex controls what? How many? Curve? It's just crazy. But that narrative only goes so far. Look, so if it's 40 to 1, 40 convex to 1 cleaver, that might not be right. Then it's one cleaver controls 400 curve. So one cleaver and curves at what? 60 cents. So 100 is 10 is $6 worth, 6, 12, 18, 24. So one cleaver controls $24 worth of curve. Is that right? No, 10 curve is 60 cents. So 100 is $60. Jesus. No. So Cleaver just controls a tremendous amount of curve voting power. I don't know. That was always something that caught my fancy, but it doesn't mean anything because the general public doesn't understand it. It hasn't registered. So Cleaver just goes under the radar, continues to be priced at what it's priced at. And there's nothing you're going to be able to do about it. But does that invalidate the narrative? No. That's why I like to retain my Cleaver exposure. $4. $4 to control 400 curve. What kind of joke is that? What kind of joke is that? What kind of joke? All right. Eunice in the house. Hello, Cap. Good morning, rational people. Eunice, when will the market structure change, Cap? The market structure looks great, though. Give us the hopium. So here's the problem, and this is why it's almost a little bit tiring doing social media for crypto markets. Because everyone's wrong, and they're not just wrong about when the markets will be bullish. They're wrong about the whole philosophy of what's the point of looking at markets. Now is the time to, the time is always now to look at markets because the rules that I have laid out, rule number one especially, means all right, what does that have to do with market conditions? Rule number one has nothing to do with market conditions. Rule number one is very simple: own more assets. All right, so what kind of assets do you want to own? This has nothing to do with headlines or media, social media, mainstream media, nothing. Rule number one says own more assets. All right, great. Hey, dude, go own more assets. Where? NASDAQ? S&P? You want me to get a Coinbase account? What the fuck is a Coinbase account? All right, so people got to figure their shit out where they want to own more assets from. Rule number two, know when to stop owning assets. All right, fine. Now you got to understand a little bit of the market. But that's something you're not really going to process for at least like 3 to 5 years because you have to know when you have to have experience when the market is good slash bad. Well, good and bad, not at the same time. You have to know what it feels like when the market has been good. And then you have to know what it feels like when the market has been bad. And then you can assess when you shouldn't be executing rule number one. And then rule number three, it doesn't have to be everyone's rule number three, but my rule number three is fuck you, pay me. It's a qualification for assets because you can't own everything. And you have to have criteria, attributes that allow you to say, nope, not that, not that, not that, not that, not that. That's the only way to isolate and identify potential investing opportunities. So what is the rules that I just laid out? What does that have to do with whether the market's good or bad? This is a process. This is a mentality. So I firmly reject the need for hopium. What people need is reprogramming in order to expand their mind and to think about why they do what they do. Like, it's much simpler. The whole system, the whole of reality is much simpler than people think it is. Like, there's no secret to investing. It's just rule number one: own more assets. All right, fine. You might get some of them wrong, and if you have more of an education, more of an attention span to macroeconomic content, then you'll probably get a greater percentage of your picks right. And maybe you don't understand cash flow or don't have enough capital for cash flow. All right, great. So still executing rule number one, So the only variation there is whether you get 2 out of 20, dare I say 2 out of 20, not even 2 out of 10, correct over 5, 10, 15, 20 years. But over time, that's got to increase. No matter how bad someone is at looking at markets or how resistant someone is to actually getting an education in financial matters and macroeconomic type of conversations, still got to get better over time. I mean, how many people could buy, whiff, and bonk and skibbity? I mean, I guess I'm wrong. I guess I'm wrong. I guess people could just fuck up over and over and over, and they don't learn their lessons. I guess that is the case. That's probably what everyone is thinking right now. They're looking at me as like, Captain thinks people could get smarter over time, and then everyone's thinking, nope, yep, they're just gonna keep buying the next shit meme coin, and they're gonna fuck up all over again. Fuck. I'd like to have a little bit of faith in humanity that there's a chance for people to be rational. That'd be nice, right? Maybe that's why I keep with the stream. Because every one person, any one person that could potentially become rational from irrational, that's got to be meaningful. That's got to count for something. Greg says, can you educate us on RWAs, where it's at, and if it's a meaningful metric? Yeah, well, my perspective will be very different than most because other people will look at, ooh, what could I own and invest in the RWA space because it's a buzzword. Well, like an Ondo or a Frax, FXBs and stuff like that. It'll drive you nuts. Which is, it comes back to how do I navigate, and I have my base layer maximalist mentality. So, what are RWAs? It's basically a derivative that is bringing external money internal to the crypto space. So, it's an on-chain representation of exogenous money. Now, obviously, that's a loaded statement because what is money versus what is currency is a critical prerequisite to understand that statement. Um, the money in the current global financial system is basically debt, primarily US government debt, but also in good part international debt or international denominations in foreign currencies. So, and that money is used to print currency, and that's exactly why it's interesting. If you measure the RWA space, you get a sense of how much potential there is for money in the crypto space to print endogenous currency. If you got, I mean, but then again, that you could have RWAs, but you could also monetize native assets. So you bring it on $500 billion worth of US 10-year debt, let's say, or you monetize Bitcoin and it's 200 grand. It's something very comparable because in the sense of money and currency, both the on-chain debt instrument and the Bitcoin serve the same purpose. No one's really settling transactions Bitcoin denominated. They can, they do. So it's kind of like it would be equivalent to a person settling a transaction US using US 10-year debt. All right, fine. You could probably see it like bearer bonds. That's a very timely statement. You ever hear of bearer bonds? Bearer bonds. So it's a if you don't have this piece of paper, you don't have a bearer bond. So that was always an interesting historical concept for a financial instrument. Physically hold them. So obviously nowadays there's complexities with regard to fraud and illegitimacy and stuff like that. But um, well, of course you could settle a transaction using a bearer bond. And so that means um, it has you're not going to digitize a bearer bond, but with the world where it's at and government debt, you could digitize and have a tokenized representation of government debt, and that has an equivalent, similar functionality to primitives or crypto primitives, Bitcoin, Ethereum, gas tokens. And because you took the U.S. government 10-year or any government debt instrument and you tokenize it, I mean, technically you could settle the transaction in the same way as. So everything is turning into a blur of financial possibility of what you can and cannot do with various instruments. So I'll try and keep it simple, Greg. It's all about money. It's all about currency. The more money, the more currency. From a crypto space standpoint, what you want is more money and conditions that favor more currency. So conditions that favor more currency is basically low interest rates and low collateral volatility. And you also want a cheaper dollar because when you have a cheaper dollar, foreign currency is more expensive. More expensive, more purchasing power, so on and so forth. So that is where you'll want to follow the DeFi llama. You'll see all of that result in everything with regard to RWAs. You'll see play out in stablecoins. If you see a significant increase in on-chain RWAs, stablecoins will be up and to the right. Okay, and this is really the metric that matters. If you have more stablecoins, you have more dollars that could purchase things. And that means things go up in price. Um, and that's the foundation for what everyone screams about with regard to inflation. Oh, the government prints money. All right, great. So the government prints money, more money in circulation, higher prices for things. All right, so if you want to see crypto go up in price, you want to see more dollars in circulation, more money, higher prices. So we're way past the trough, and we're not even near the peak, and that's a remarkable number to say the least. $238 billion, up $1.79 billion, what 1.79% for the week, a $4 billion bump in total currency in the crypto space week over week. So that's the metric to watch is the total dollars in circulation. I love this chart right here. Very simple. DeFiLlama.com. Teddy, good morning, Cap. Much a pleasure. Peter P, good morning. Yo, Maxie, yes, we love you, Cap. I appreciate you guys too. The few, the proud, the rational. And it's a little bit of a dwindling community. How many people have avoided financial catastrophe or financial mishaps, have avoided the insanity of whatever is and has potentially enticed people from a meme coin standpoint. It's not easy to survive and continue to exist in this kind of space. You need a different program. I mean, literally 18%, 500% risk free, give or take. 4, 12, 16, 400 and something percent risk free. That's crazy. That's a massive number. So some people like to gamble and they want to turn $100 into $1 million and they don't see another way to do it. I don't know. I spent my 20s working, I spent my 30s working. Call me old school. Call me old school that I worked, accumulated capital, and I did it that way instead of going to the casino and YOLOing and seeing no hope and despair and no chance at a future. And maybe I was the last generation that actually could do it the old fashioned way. I don't know. I don't have the answers to this. I don't know. Anyway, maybe that made sense. Maybe it didn't. Cap, very curious to hear your thoughts on locking VE Squill. Oh, well, Leviathan is a heck of a product. I believe I'm one of the largest holders. I should look up those numbers, and I'll state it all publicly. Why not? And Squill is what the index is was the governance that controls their index. And if anyone understands how to manage voter escrow and whatever they have up their sleeve with regard to incentives and whatnot. That could be very interesting. But bear in mind, it's a derivative product because in the end, it's a consumer of curve finance type technology. It's not a forex market itself. It's not a credit market. It's not a business. It is. It's fine. It can have business-like characteristics from a news outlet standpoint and governance, and that's all meaningful. And but it's not ultimately a base layer infrastructure type of business. I guess that's my point. So from my standpoint, I got to see what I got. I probably have a fair amount just sitting around. But what am I going to do with it? I don't borrow. I don't like credit. So look at the value. The value is very nice. Um, let's not pull it up right now. But the point is, the price point has looked very nice. But I'm not going to borrow against it anyway, so it doesn't matter. I'm not going to sell it. I fall into that Charlie Munger camp. I'm not good at selling. All right, great. So I don't sell. So that means I have to be that much more picky about what I buy. And this isn't related to Squill or Leviathan in any way, but it just means I like to accumulate more assets. I turned everyone's story of hodling and bag holding, and I turned it inside out. I turned it upside down. I guess that's one of the biggest takeaways that I would love to be known for, to invalidate or highlight how short-sighted those terminologies, hodl, how short-sighted those terminologies are. Just hodl. No, there's not just hodling. There's infinitely more conversation to have because if you say the word hodl against my rule number one, it's like, what about rule number two and rule number three? And then dare we try and understand these markets from a financial perspective? And you realize how shallow and trivial it is to say hodl. It's just, all right, let me turn my brain off and ignore everything that could potentially be learned and just own something. Well, but what about invalidation? There is invalidation. So what's that? Rule number four? Add a rule number four. Own more assets. Know when to stop buying assets. Rule number three, fuck you paying me. And rule number four, the only condition for liquidating an asset is invalidation of the original narrative used to acquire the asset. So first off, if something is invalidated that you originally thought was correct, you better stop and reevaluate how you're determining what to invest in the first place. You should not be getting that wrong. You should be investing in shit that is like no questions asked. Let it play out. And you should have that conviction capacity to let it play out. And if you don't, you bought too much. What was the only did I was in and out of Aura and Convex. That was about it. I haven't sold anything. But see, that's the thing. Aura and convex, they're not invalidated with regard to narratives. They're just invalidated with regard to uh, what I look for in investments because they're rule number three, or I'm sorry, they're business number three. They're derivative products. And all right, fine. Rule number four, I invalidate them as investable because I don't prefer and I'm not comfortable with exposure to derivatives. And I ultimately don't need exposure to derivatives because I own Balancer, I own Curve. I don't need to own Convex and I don't need to own Aura. So that allows me to own less, but still I have exposure to those names. So that's why it's one of the most important things we do is look for reasons to not own things, to have a more concentrated portfolio, and you likely already have exposure to things without even actually having own things, if you know what I'm saying. It's like technically if Bitcoin, um, if Ethereum's rallying, everything else is rallying in the crypto markets. And it's in some regard the same for Bitcoin. The narrative's a little different though nowadays. Bitcoin, look at dominance. 64.37. Anywho, any thoughts on Ramsey's multi-chain potential? Ramsey's was one of the best investments when it first came out. Why? Because it afforded Linnea exposure, Mantle exposure, Nuri exposure. What was it? Nuri? Or is that the protocol on Scroll? No. So, yeah. So Scroll exposure. Um, and Sonic exposure. So I got the timing wrong on Ramsey. So I have my mistakes. In hindsight, my mistakes were purchasing um, Cleopatra and Nile. I should have acquired that vis-a-vis ownership of Ramses at a more opportunistic time. Now, fortunately, it wasn't the worst timing because that did play out okay with regard to shadow exposure, which was free exposure because of Ramses. Now, um, I don't know how much more expansion is to be expected. I don't know what their entire play is, um, but that is generally my position. I already have ownership of Ramses, Nile, Cleo, Shadow, and it is what it is. And it was the original appropriate position size. So I have more than enough capacity to let it play out. And it gives me, frankly, exposure to each respective network. Arbitrum, Optimism, Linnea, Mantle, Scroll, Sonic. Yay! So that's it. So I kept it simple. Uh, am I fond of what's going on? No, Arbitrum is bleeding out. Notice I didn't say Ramses. I said Arbitrum. Look at Optimism. Optimism isn't doing well at all. Bone dry. Very little liquidity. So I certainly don't like what I'm seeing there. And it's hitting Velodrome's numbers very meaningfully. It is what it is. Am I more interested in the way things were built with Velodrome as compared to Kingdom? Velodrome. I like the super chain narrative. I'm more interested in that, albeit we'll see what Kingdom has up their sleeve. Because I sure as hell am content having exposure on Sonic, and I know Arbitrum isn't going to fade to dust, and I know that Linnea is a very interesting consensus narrative. Listen, that's the whole point. That's why it's very hard to invalidate things um, once you determine that there is something substantial. So it's much easier to say, why can't I own something? I don't have enough money. Position size is a critical consideration in determining if you can even take an investment. If you can't acquire an appropriate position size, you can't invest. In a more concentrated portfolio, which is increasingly healthy. Um, anyway, hope that helps. After Friday talk, I looked at Contango. It's a money printer, very under the radar, and DMOR on it looks good to me so far. Yeah, I took a nice size position. It's down probably what 50%, a little more, 60%, but it has done very well. I very much appreciate my Contango exposure. Um, very underestimated, in my opinion. It's a heck of a derivative product, and it facilitates one of the greatest money makers in crypto markets, leverage, which is called looping, which is basically called the carry trade. Um, you're not going to get the same kind of leverage you're going to get on a perp exchange, but you could get multiples and enough for me to appreciate the product that that's probably actually the only derivative exposure I have. Go figure. But yes. Um, Cleaver is also under the radar. I like the mechanics, good cash flow. No, it's not good cash flow. Maybe it is, but let's see what the cash flow is actually for the fun of it. Voting. Huh. I don't have a Cleaver page. Island Club, that's why. Cleaver. Get the fuck out of here. 33%? Okay. Okay. All right. And obviously that's going to vary, and that's probably juiced a bit because of resupply. That's pretty cool. Did I really lock 265,000 Cleaver? No. I locked 5,000 Cleaver. What the hell? Can you imagine? So what is that? That's I should maybe take advantage of a discounted price and lock some more. 4,500. Extend lock. I don't have my keys. I should bump this up. 783. That's cool. It's like 1,500 bucks worth of convex. I mean, that's been sitting there for a long time, folks. So that is not 5 minutes worth of Cleaver cash flows. How's the little concentrator doing? I like concentrator. I like it. But let's see what its lock rate is. 27%. Nothing to sneeze at. What do I got saved up? Your lock, your share. Do I really have 24,000? No, that's my share. I have 2,200 ACRV. Curve at 60 cents. $1,000 give or take. 1,200 bucks, 1,400 bucks. Couple of bucks saved up. Cleaver. Anyway, good shout out on Cleaver. I think Cleaver is like 11% of CVX lock. Well, it's more than that. Cleaver owns 13.25% of locked CVX. But what's most interesting is they are the largest locker of convex. Therefore, if you have, so I'm pretty sure actually I have enough Cleaver to pass a Cleaver vote just by myself, quorum, which means I could pass a Cleaver vote. Therefore, I could direct the voting of 4.8 million convex. That's a whole lot of voting power. That's an interesting one. Jesus. Anywho, anything else? Let's close some of this stuff up. Let's go back to analytics maybe for 5 seconds. We could look at fees and revenue. Not fees and revenue. I want to look at volume. Volume by DEX. And we'll wrap it up for a Monday, ladies and gentlemen. If it loads. Let's go to mainnet. Fluid, 108 mil. Very interesting to see what Fluid has built. Let's go over to base where we'll see Aerodrone on top. Damn. Uniswap making some moves. Silly? Anything interesting? Yeah. Arbitrum. Say Ramses has fallen off the damn list. But look at Curve. Look at curve. It's because of cross curve. This is cause of a lot of things. That is a tremendous number. Curve never really had a strong presence off mainnet. That's pretty nice to see. Pretty nice to see, to say the least. I mean, that's just a 155 mil. That's going to be interesting if Velodrome tops Uniswap on Unichain. Jesus. Sonic. Shadow is the dominator by a lot, actually. That's cool. That's good to see. Okay, let's go OP mainnet. Velodrome's still quite dominant over Uniswap, but look at that. Look at Curve making some moves off mainnet. Solidly with some strength. That's interesting. Okay, that's about it. I think that covers the interesting stuff to look at. I hope everyone has a bit of a different perspective on markets. That's always a hopeful takeaway from the end of any stream where I'm talking about what the heck is going on in these markets. Try and t- get a takeaway. There's got to be takeaways from these conversations that between you and I. And everyone's takeaways should be different because they're all in your own language, the way you understand markets. And every couple of streams, you have different takeaways, and we evolve over time with new ideas, and we make our own new interpretations of the way things are. We understand things a little bit better. So may I leave you today with some good takeaways. Monday, April 28th at 12:27 p.m. Thank you all for joining me today. 161 people made it to the end of the stream, and you are all now a little bit more rational because of it. I wish you all a good one. Stay sane, keep it real, stay rational. I will see you guys and gals later this week. Till then, peace.